Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Our very first guest in 2022, back in January, was Rich Nuzum, the president of wealth at Mercer. Mercer is a global giant with almost $400 billion of assets under management and more than $17 trillion under advisement. Rich did a brilliant job of laying out the global investment landscape. I'm pleased to say he's agreed to join us again today from New York. Rich, welcome back to Fear and Greed.
Thanks for having me back, Sean.
It's been quite the 3 or 4 months since we last spoke, hasn't it?
It sure has. A lot of risks that we talked about 3 or 4 months ago, unfortunately, have come to pass on the downside. And so volatility is very high, markets are lower, and the world is a bit scarier place with a major humanitarian crisis underway than it was 3 or 4 months ago.
Okay, so let's start with the big one, which is inflation and US interest rates. We're basically likely to get a 50 basis point increase next month from the Fed. Inflation has certainly soared in the US, and that's set the cat amongst the pigeons in global markets, certainly. How do you see that playing out?
The markets are betting that the Fed and other monetary authorities will be able to bring inflation under control without raising interest rates by catastrophic amounts. So let's take the US dollar nominal yield curve as an example. The 10-year Treasury, as I entered today's call, was trading at around 2.8%. And the yield curve was inverted between midterm and long bonds. And what that's basically telling us is that the market thinks the Fed can raise interest rates in a series of moves to something like 3.25%, 3.5%, get inflation under control, and then reduce short-term interest rates. So the market's actually betting that the monetary authorities globally are highly competent and can bring inflation under control by changing investor expectations. And what I mean by that, not just investor expectations, but real economic expectations. Yeah. So the bet that we're all kind of collectively making at this point is we don't need interest rates at 10%. We don't need a massive recession with unemployment rates above 10%. That as people see the Fed do, for example, a 50 basis point increase and communicate to the markets it's willing to do 6, 7, 8 interest rate increases, it's willing to do what it takes. And other monetary authorities also communicate we're willing to do what it takes. That will bring inflation expectations under control, that individuals will be less likely to seek a wage increase. The companies will be less likely to seek a price increase because they believe that inflation is going to be brought under control relatively quickly and relatively easily. That's a huge bet to make against historical experience. The monetary authorities in recent decades have become more and more competent at managing inflation expectations and communicating well with the markets to avoid surprises. But the fact that volatility is elevated, that the VIX, which is a measure of 1 month forward S&P volatility, is trading in the 30s, which is actually higher than it was during the early stages of the Ukraine-Russia war, says that there's still confidence that this will happen, but less confidence than there was the last time we spoke.
You're not worried about a boom-bust scenario?
Oh, I think we're in it. We've had the boom. Labor markets are as tight as I think they've been, certainly globally for developed markets, as tight as they've been in our lifetime, tighter than they've ever been. We have record low unemployment levels, even though labor force participation is rising in many European countries, and the types of low unemployment and really a labor force shortage in developed markets. And that's despite the impact on demand and confidence of the zero COVID policy in China and disruptions of supply chain, both in China more generally, and then the Russia-Ukraine crisis and disruptions on supply chain and confidence from that and high energy prices. So despite some economic headwinds and concern about possible recession coming out of these monetary authority actions to rein in inflation, we have a booming economy. We actually have a secular overheating economy. The underlying trend is a secular overheating economy. And then on top of that, we have these two stagflationary shocks of zero COVID in China and Russia's unprovoked invasion of Ukraine with associated disruption to global supply chains and global growth in the first instance, and for China, and then for Russia, disruption to energy supplies and supplies of other key materials and even of food supplies, given Russia and Ukraine's major role in the world agricultural markets pre-war.
Okay, so just quickly on these, because I don't want to spend too much time on Ukraine and China, but is it the fact that with the invasion of Ukraine, we're kind of getting used to it and markets are taking it a little bit more in their stride?
I think you're right, but I'll take a second to comment that the humanitarian crisis is huge and occupying thoughts for a lot of people, including investors But when they then look at the economic implications, the markets did relatively quickly factor in the risk and other impact of the invasion. And I think it was 3 weeks after the invasion started, markets were trading higher, stock markets, than the night before the invasion. And the volatility index was back down to a lower level than the night before the invasion. So the fact that this did not become a shooting war between NATO and Russia, thank God, or at least has not yet, the markets didn't get their worst case scenario. And I recognize saying that the humanitarian crisis is huge. But yeah, markets largely factored it in. Now, markets are still factoring lower growth for Western Europe as Western Europe tries to move itself away from Russian energy supplies and dependence on Russian gas in particular. And Russia's most recent announcement of cutting off gas supplies or disrupting gas supplies to Poland and Bulgaria. Last time we talked, I think I opined that I hoped Putin wouldn't move forward in the invasion because it would be horrible for Russia, that Russia would get kicked out of the global economic system. I don't think I foresaw how quickly and thoroughly that would happen, the level of sanctions coordination. But cutting off gas supplies to two neighbors that are already worried about your aggressive tendencies, that's just going to accelerate energy independence in Poland and Bulgaria and in the Western Europe. And that's not an easy thing for democratic governments to navigate, to tell their citizens, hey, we're gonna do something really painful for our economy. You're going to see your prices go up. You may even not be able to afford to heat your home, but we're going to do it for the greater good. That would have been tougher if it were for the Ukrainian people than if it's in response to really aggressive action by Russia, including actually cutting off the supplies. When you say to people, we want to do this for the greater good, that's tough. When you say we have to do this because our neighbor just cut off our supplies, well, that's a national call to action. That unifies people. So Once again, Putin's engaged in activity that's actually unifying his enemies and going to realize his worst case scenario more quickly than if he'd not taken that action.
Stay with me, Rich. We'll be back in a minute. I'm speaking to Rich Nuzum, President of Wealth at Mercer. Okay, closer to home, the zero COVID policy followed by Beijing. Obviously, that has hit commodities, which affects Australia directly. The question for Australia particularly is how fast will China grow in the next year or two? And do you think it will stick to the zero COVID policy? Because that has economic growth implications.
I don't know if it will stick to the zero COVID policy. I think there are two underlying uncertainties on that. One is who's advising Chinese leadership, and is it an echo chamber or will they get diverse views? So will the idea that the economic harm being done by zero COVID is bigger than the economic harm of opening things up and letting the virus run its course? Will that debate happen in an open, transparent way as it has in other nation states? And we've ended up now pretty much opening up and letting the pandemic become endemic and run its course. Will that debate happen in China and have the same result? The other uncertainty is how well the domestic Chinese vaccines actually work. So the kind of conspiracy theory that market strategists are really worried about is the problem actually that the Chinese vaccines don't work as well as the World X Chinese vaccines. And so the Chinese government knows that and will not let the pandemic become endemic because its population doesn't have the resistance that much of at least the developed world has built up through vaccination. So by letting it rip, they'd have a much worse health outcome than we've seen in Australia, Western Europe, North America from kind of letting the virus run its course. Now, the virus may dictate not policy, but the virus may run its course anyway. It's become more and more transmissible as time has come on. It's not clear that the lockdowns, they may restrict growth in cases, but they don't ultimately keep the virus from spreading. So even in the Chinese case with fairly draconian policy. So lots of uncertainties there. Long term, China will grow quickly and be a locomotive for the global economy. But how quickly China relaxes the one COVID policy, there's no certainty about that because we don't know to start with what that policy debate will result in. But then the underlying kind of science of both progress of the virus and effectiveness of the Chinese vaccines, again, open questions about both.
Okay, now, Rich, I can't not ask you about tech stocks. The earnings season in the US has actually been pretty good. Mind you, the market hasn't reflected straight out earnings. The tech stocks, it just seems to me that extremely volatile, but the good companies with diverse income streams seem to be doing okay and the others aren't.
Yeah, I think in a way it's a return to fundamentals, and it's heartening. Even though if you're a tech stock investor, you've had a rough ride year to date. What's basically happened is that the companies that have missed earnings projections or taken their revenue curves down have gotten absolutely hammered by the stock market because much of their stock price is reliant on expectations for future growth in earnings, not current earnings yields. And companies like Microsoft that beat earnings have been rewarded, at least on a relative basis. So it's a return to fundamentals of if you deliver what the street expects and your business model is working, you can maintain a high valuation. If you miss or you change expectations because your business model is being impacted in a way that you hadn't told your investors about yet, then your stock price is going to get hammered quickly. I think also the rise in nominal long-term yield curves with what we talked about earlier on monetary policy and expectations about that. Again, it's not long-term US dollar yields at 6% or 10%, but even a rise from sub 2% to high twos, that discounts those future earnings of the tech companies at a much higher rate. And so their prices were going to be hurt more than companies that are very reliant on current earnings yields.
Yeah.
But I think really the volatility in the sector, and as you flagged, the big gap between what's happening to stock prices of winners versus losers, it's all dependent on what is management telling their investor community about how the business model is working and is going to work, and really the quarterly scorecard of what earnings and what cash flows are they actually delivering. And the companies where that story is maintained are doing fine on a relative basis, even if the overall market's down. The companies where there's a disappointment in that or a change, where, for example, pandemic reopening takes your number of subscribers down instead of up in a business model where everybody expected subscriber growth to continue, you're going to see a big change in your valuation, but still have a profitable business and still have growth. And it doesn't, none of this changes the appetite of the institutional investors we advise to invest in venture capital, early stage growth, tech in general, or of strategic companies, big companies to pursue digitalization. I mean, those trends are all alive and well and running under the surface, but there are individual winners and losers at a company level.
Okay. The other trend, the final one I just want to mention is ESG. We heard so much about it last year. It's come off the boil, at least in terms of the media headlines, as much as anything because of oil and gas prices. But in terms of investors, it remains as important as ever.
It sure does. And not just E and in particular climate and carbon, but S with labor practices and the practices of the nation states that are hosting the companies that you're investing in. I think that's gotten greater scrutiny post Russia's horrible actions towards Ukraine. But I think what's changing in ESG is a shift away from simplistic divest or be named and shamed one size fits all approaches to a view that actually, for example, the traditional energy companies need to be part of the solution. And they're not the problem per se. The problem is we have a global economy that's reliant on carbon emitting energy sources. A lot of the supply chains we need to access with renewable technologies to fix that. A lot of those really smart scientists that would commercialize in renewable technology and get that energy in the hands of consumers and businesses are working for the traditional energy companies. And the traditional energy companies, by and large, are playing a really important role in migrating power grids and energy away from the worst carbon emitting sources towards renewables. And we don't yet have the battery technology, and we don't yet have the volume of production. We don't yet have the cost curves down to where the global economy can switch to 100% renewables, but we're definitely on that path. And so a kind of naive divest all the traditional energy companies and only invest in renewables, it, in my opinion, doesn't work. It doesn't fix the problem. If everybody did that and we had no traditional energy companies, we'd have massive poverty. And I think one thing we've seen is that when an economy is doing well, a democratic capitalist country can adopt ESG policies and pursue transition as power grid and do other things that help fix this problem. When an economy goes into recession and has high unemployment, even the U.S. economy under the first Obama administration, that as an example, the Obama administration came in with the intent of putting a price on carbon and doing things on climate. And the economy went into recession, and that policy could not, as a practical political matter, be pursued. So we have the strong underlying economic growth, the overheating that we talked about earlier. We've got some things to get through in terms of supply chains and inflation and energy price disruption. But to the extent the global economy continues to do well, that will create room to solve the climate issue I'm very optimistic about disruptive technology. I follow the cost curves closely because our clients are invested heavily in clean tech and green tech. And so we can see the renewable energy cost curves coming down below traditional energy sources. And then the issue then is, how do you get that energy to where it needs to be? And there needs to be further innovation and generation and batteries and so on. But a lot of that technology and know-how is with the traditional energy companies. So most of our clients are pursuing brown to green and partnering with traditional energy companies to make renewables happen, as opposed to a more naive approach of, you guys are evil and you guys are good and we're only going to invest with the good.
Rich, thank you for talking to Fear and Greed.
Thank you for having me again.
That was Rich Nuzum, President of Wealth at Mercer. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.